right, well, welcome everybody. Today I'm joined here. My name is Paul MacNeill. I'm the VP and GM of Payments at ConnectWise, joined by Jon White, who is our Senior Director of Product at the Payments team for ConnectWise. So thank you to everyone. A little bit about, I guess, why we're here today. For those that are aware of the modes theory, one of the most important parts of the knowledge and understanding around where you exist in the life cycle of business. Whether you are at that startup stage, balance builder stage, or value builder stage, this is applicable. I think empire builders, if you're an empire builder, you're probably in here to acquire businesses because that's what they're there to do. You saw the pitch on stage today with Evergreen coming in and talking about how amazing the opportunities are for growth-based investment in you as an MSP. And one of the things I think is important is understanding your part of that life cycle and how you sit inside modes theory can help you drive a better understanding of where you are in, more importantly, in how you grow your business. Because there's different things, different problems and challenges that exist at each stage. So a little bit about WisePay. For those that aren't aware, WisePay and WiseSync were acquired by ConnectWise back in September of 22. So we became part of the ConnectWise family. I was the CEO and owner of the company, founded the business back in 2012 as a need for our business, which ultimately was the creation of an accounting integration between PSA, or as we knew it back then, just plain old ConnectWise, and now what is obviously the Cloud Accounting Technology Xero. We expanded that out into Cloud Accounting Technologies QuickBooks Online, so offering a more in-depth sync than what you could get with ConnectWise at the time, as well as creating a payment platform, which is WisePay in 2016. My experience as an MSP dates back to about 2004 when I first started doing SBS installs. For those that have been around for long enough that knows what small business server was. Transitioned across into managed services around 2006, working closely with technology and RMMs and other things to create better value for my MSP. Through acquisition and growth, we grew that business and I exited that company to a larger MSP in Australia called PowerNet Group, which is now part of a much larger business called VITG, which is more of an empire builder as it comes to that. So I've been through all phases, the startup, right all the way through to the balance builder. So thinking about where I've been and more importantly, probably where you are, you might be here as an owner, you could be here as someone who represents the finance function, a controller, an accountant. The platform and technology we created really is central around creating efficiency and more importantly, value. And you can see my experience there is really centered around how I grew an MSP business and how these technologies help that through that journey, not limited to obviously doing the work that needed to be done. I was good at the technology side, creating value was what ultimately the outcome was. But these are the technologies that helped build and solidify that value at exit. Because you can have many things that foundationally drive business value, but there's a few that you could focus on and we're going to go through those. Now I'd like to introduce Jon White. Jon started with ConnectWise about 2 months ago. So Jon, why don't I hand over to you to tell more about your story?
Yeah,
payments.
Thanks Paul, and hello everyone, really welcome and really lovely to be here. So great to present in front of you today. I'm an experienced product and payments leader, having run technology services across fintech, I've run SaaS companies, enterprise banking and startups. Most recently exiting a startup business in payments technology, and therefore joining Paul now as a Senior Director in Product Management, running the payments function. What gets me out of bed every day as a technology leader is really solving problems that matter, solving problems worth solving, and yeah, in the end, creating undeniable value. So we're going to be talking to you about a number of ideas today that we can share around providing those types of services. But before we kick it off, I wanted to ask you a question, Paul. We're here to talk a bit about cash flow. Can you give us your view on what's changing in the MSP landscape in regards to cash flow at the moment?
Well, I think it's important when you look at how we mechanically approach managing our own cash flows. Whether you are doing a lot of project services, whether it's recurring revenues through managed services, or whether it's just selling hardware. Some of the things that you need to think about is as our economy tightens and the pressures on cash flow from our customers themselves becomes paramount, They will use you as a mechanism to survive. Cash flow is critical in business. It's the oxygen. And when we look at businesses that have survived through long-term, hundreds of years, and we think about some of the biggest businesses that have gone bankrupt, it's usually on the back of cash flow. Cash flow kills businesses. If you don't have the right liquidity in your business, you can't be in business. It's trading insolvent. So if you need to focus on and understand in your business what these critical cash flow drivers are, you can just walk around, Curtis, all over there. That's fine, thanks. The most important piece about the strategy for cash flow is being aware of it, and more importantly, understanding the function of cash flow in your business. Don't have cash flow, can't survive. And when we think about the changing landscape in this industry, you've got a lot more pressure now. The economy's changed, there's no question about that. Businesses are saying, and we've seen through the SLI data, that we are in obviously a growth market. MSPs, TSPs are growing, consistently growing. Whereas if you look at the economy as a whole, it's very different to that. And you're going to have exposure to your customers through that exposure to their businesses themselves. They may not be in an industry that has the same growth metrics. They may not be in a business that has good cash flow. Your managed services invoice can drive their business into cash shortfalls and pressures. But them not paying your bills doesn't help you pay payroll, doesn't help you pay your MSP licensing costs or your Microsoft Office licenses that you buy through, whether it's Arrow or Synex or whoever it is. I think it's important to understand that you have a high cost that is traditionally being challenged in margin. So if you don't have good management around payment automation, you're going to have a lot of pressure on your cash flow that may actually make your business unsustainable. So that's a really important factor to that journey as well, John.
Awesome, thanks, Paul. Well, we are going to talk about, when the slide flicks over, one back.
Oops, sorry, too far.
We're going to talk about a few things today. Get the slide up.
Which one?
The next one. Cool. We want you to go away from this session remembering one thing. We want you to go away with remembering several things, but if you can go away remembering one thing, it's to know that from start to exit, your business is always for sale. So keep that in the back of your mind as we go through these slides over the next 40 minutes or so, as we share some stories across our experiences, both in the fintech space and also in Paul's experiences in MSP. So what we are going to talk through is 6 pillars of business valuation. I might just pause for half a second. I'd encourage you to take a photo of that slide, because we're going to go into each of these in a little bit of depth. I'll give you a second there. As you do that, we're going to start about some stories around some staff processes and systems, linking that back to that modes theory themes that we've been talking about across this conference as well. Some good stories to share that we've got. We're going to talk about the importance of recurring revenue and service revenue, why it matters, why differences matter, and why you need to understand it. We're going to dive into customer contracts and the relationships between yourself and your partner, your customers. We're going to dive into a little bit of financial management and continue that conversation around cash flow, stability, and predictability. And then we're going to wrap it up by the most important thing, that bottom line, EBITDA. And we're going to start with you, Paul. Tell us some of your stories around staff, process, and systems.
Well, I'd have to say I've hired wrong people, and it's been very, very costly and brutal. The point being is that as we move through and transitioned in our business into more greater understanding around operational maturity, or in service leadership, they call it the OML, the right person, right seat becomes critical in function. The right person doing the right work. And if you understand or have heard of the book Traction by Gino Wickman, EOS is obviously a big part of what the businesses were that I ran and still continue to run today. In fact, we use EOS through our business unit in ConnectWise, and it's something that we're really proud of and shining light of as well. So John, maybe your experiences too from understanding what the right person, right seat means.
I'll share a story with you. I'll probably go back to the role where it was a startup. I was a co-founder of a payments fintech. And as a startup, you're very immature as a business. I think the key thing to know that as a startup, is any hands up, is there any startups, modes theories in here?
Or modes theory startup.
Yeah. No, not yet? Well, then you probably know, or if you're about to enter into or thinking about entering into a startup, your founding team need to be generalists. So that means you need to be adaptable, you need to have full coverage of all the functions and do a pretty good job. Do a pretty good job. I always say to my team, you've got to be happy to sweep the floor at the end of the day. You know, you're doing absolutely everything and you're ignoring job titles. It means absolutely nothing. But as you scale, of course, you need to start to think about specialists. Specialists that can do these functions better than you ever could, and you can't be ashamed about that. You hire them for specialists for a reason. You need to scale your business. Probably a story I can share as well. As a generalist, I grew my business, I stood it up, built the product, got the early sales, got the early traction. Then my attention was moving into customer implementations. And that was great. I was happy to do that for my early adopters, my early customers. But that's not my specialty. And I was more than happy to put my hand up and say, there's better people to do this than me. So I looked to hire a head of customer success that would start doing these types of functions. They were better than me. They actually could take the reins and improve what we were doing so we could scale. And we built out that customer success function more and more, allowing me to step back from the business and look at other operational activities. So the point being is full coverage over in the earlier stages of your business, moving towards specialist skill sets.
And I think a great example of that too, most recently, we had a role in our business unit, WisePay, was a head of product and engineering. And that person was a generalist. They had great product skills and a good understanding of engineering. But that's not what we needed. What we needed was a product leader and an engineering leader, because we need to innovate and we needed to grow our product methodologies to create better outcomes for the product and for our partners. And that was one of the things that Jon came on as an experienced veteran capable of delivering great outcomes, but the right person, right seat helps to define that. And as you go through, and anyone that's been through an acquisition, people are one of the biggest parts of the assets that you're accumulating. The right person in the right seat is an untenable value that you cannot diminish. If people look at it and say these people can go because they're not contributing, or we can rationalize, then you're going to have discounts in your valuation because of those things. So look at how you approach people in your business as a part of the value and the mechanics that sit inside of that. So let's talk a little bit about recurring versus service revenues. Jon.
Cool. I've got one story to share from my business, and it's pretty obvious. When you're growing and you're looking to scale and you're looking to improve your valuation or looking at your exit plan, you need to look at recurring revenue. But that's not to say you're going to be looking at other lines of revenue as well. But you want that predictability and serviceability. So what that means to me is we're looking at ARR, and at least in our experience, we're looking at annual recurring revenue. I think it's probably more akin to, you're probably looking at monthly revenue for your types of businesses, but we're looking at annual recurring revenue. What we would then adopt is more of a land and expand strategy. So once we could sell our contract, we always looked for long-term contracts, 3 years minimum, and that would really mean that we had that predictability over a period of time. But then there were so many other services we could do. Short-term contract work, small bits of professional services, new product features, new modes and modules that we could bring into the business as well. That did increase our valuation, but underpinning that was making sure we had that predictable recurring revenue as our primary focus.
And I think when you look at the way the valuation methodologies work, service revenues aren't normally given a great earnings multiple. Usually it's about 1 time service revenue is what you would see in a valuation of a business that is predominantly service revenue. That's not a lot. There's not a lot of value. There's not a lot of value there because there's not that consistent repeatability. So if you're looking at how you could drive value into your business, focus on how you can create that recurring basis inside of your customer base. Whether that's productization of the services that you offer, it could be the mechanics in which you approach that too. Sometimes service revenues can be just bundles of services that ultimately aren't pay-per-use or pay-on-demand. So think about that in your strategy as well. That leads us to the customer contracts point of view. Contracts really need to be clear and well-defined. Now, from my perspective, the contracts that we ran on were month to month. So we had a month-to-month contract, which do you think that's going to increase the value? Like, is that something that you think would help me to show long-term value to an investment or an acquisition? No, I can see everyone's heads shaking. It's not going to help. But what did help was churn, or the lack thereof. We had less than a 1% churn over the course of our many years. So we could show, although we didn't have contracts, we had a very low churn, which means that we have great retention. So while we didn't have the written counterpart of a contract, we actually had the mechanism to show true value over the lifetime of the customer. If I rewind into my MSP, we focused on contracts. We focused on making sure that we had services that were bundled with products and hardware, and that created opportunities for us. Now, that may not be the same today with the move to cloud, and we're not selling hardware in data centers anymore. We're focusing on value through the cloud and the resale of technologies. So making sure you've got those contracts that support the risk associated, especially with NCE and Microsoft licensing. You may have a 12-month risk that you need to actually solidify as part of your contract. Third-party risk is an increasing priority for you in your business to make sure you're covering that. So be clear about what those mechanisms are, and obviously the redundancies in which you build inside of those contracts could be termination, it could be exit clauses, etc. You don't want to create an unfair contract in some countries, in Australia in fact. We've recently just passed legislation that stops unfair contracts and auto renewals, which basically means that someone has to contact you to opt into a new renewal. John, did you have something you wanted to share around contracts?
Yeah, I think it's just try and make it less transactional. Particularly, you're looking at more of a long-term agreement. It's more like a marriage, it's not a one-night stand or a Tinder date. Try and take the transactional element out of it and see the humans behind it.
Yeah, that's a fair point. One of the things that I actually failed to mention here is mechanisms of payment as part of contract. Who in here actually has their payment terms for automated payments, whether ACH or credit card, built into their contract language?
One here.
1, 2, 3, a handful. The reason why we want you to do that or make sure you do that is because you're dictating to the customers the way in which you do business. And the mechanics that sit inside of that is it's irrefutable, it's undeniable, and more importantly, it's indisputable for the way in which you want to be paid. So when I change from offering terms to requiring direct debit payments, we built that into the language of our contract that required the use of an automated payment from a direct debit from bank account or via credit card if they wanted to pay that cash discount removal. We in Australia can just simply call it a surcharge. America needs to call it something a little bit more obscure so it doesn't sound like surcharge, but you can use a cash discount removal for the payment of a credit card, which in all intents and purposes is a surcharge, but that's the way that it's written.
Probably one last point I can add as well when we're talking about it, it's customer experience. And I think where legally possible, make it digital. We've long gone past paper and it sets the tone. As we say, we're providing technology, we're providing digital services. Make the contract digital if you can.
Where this comes to also part of that process, if you saw the keynote this morning, you would have seen some innovation through our new integration, well not so much new integration, our expanded integration with CBQ, and the way in which WisePay will now create what's called a fully restricted down payment. The opportunity in that is you can collect payment up front, so you don't actually have to worry about what you're going to do with that money or how to apply it to an invoice that doesn't exist because you've got to jump through the conversion hoops. But the reality of that now is we've created this iron box that's in the corner for you to allocate to the project after you've gone through the conversion steps. So we've kind of unlocked the ability to create the apply to after it's been created, which for those that use down payments know that as soon as you hit save, that apply to is locked forever and cannot be changed. With this new enhancement, it will allow you to set that apply to for this special fully restricted down payment. If you're using a competitive product, you won't have that option because we're part of ConnectWise. Like we're building with ConnectWise. It's not available to third parties. So that's something to consider as part of that journey forward as well. When you think about payment providers and payment platforms, the one that's going to have the most in-depth integration is clearly the one that's owned by the company that builds the software. We have the access that's needed to make that work. And I'm not trying to say that to create a competitive moat, but the reality of it is we are trying to create the best integrated and most capable platform for you to use. And thinking about that process and understanding what we just did. John talked about digital experience through contracts. We spoke about how that becomes part of the language. More importantly, it's part of the sales cycle. So your salespeople are telling clients how you expect to be paid. Once you change the psychology of the way you accept payments at the front of that conversation with your customers, it becomes just the way we do business. It doesn't become a fight for the finance team to try and get those payment details at a later stage, creating better outcomes for ultimately what is your accounts receivable and cash flow. And I spoke briefly about it at the start. This was the defining moment in the shift in my business that moved our accounts receivable from about 48 days DSO, so day sales outstanding 48, down to 4. Best in class is about 18, and the average MSP is about 26. We took it and flipped it on its head. How? Through this. By changing the way we approached, the way we build our customers, simplifying, streamlining, and more importantly, creating the accountability at the time of contract signing. If they don't want to pay you for those licenses and those services and that offering that they're putting their signature on for that contract, that's the time when you want to know. And that's the time where you can create the opportunity to drive better outcomes for you and, more importantly, better clarity around your cash flow. So let's talk about the next piece of the puzzle. When we think about growing and scaling our business, finances are critical. Talking about DSO, getting down to 4 days, it was a milestone that we looked at as an objective that we would achieve, but the reality over time was it created financial prosperity for our business. We didn't have to worry about cash flow. We didn't have to worry about where the next check was coming from to pay payroll or rent or whatever the other things were. 97% of our business, our revenues, were generated on the first day of the month through our agreement invoicing and deposited by the 4th. Doesn't go far to say what sort of cash flow and commitment that gave to me as the business owner to make investments in technology, in systems, in tools, and of course through acquisition as well. When you have that level of clarity, the opportunities become really part of the journey ahead. And that's where one of our clients here, Tom Freer, to be able to grow and scale a business, your finances are critical. And that's where my focus has always been. Now, of course, you've got the requirement to deliver great service, have excellent outcomes for your customers to continue to provide those services. If we think about understanding your revenue numbers, it's just important as itself how you have that breakdown. Whether it's through product sales and services and recurring revenue, those are the things that good balance is always an important factor of that too. You don't want to be overly dependent on one industry or one particular product line or service. You want to have diversity, otherwise you have account risk, and that's a key aspect there. If we get into one of the things that I think is important to recognize, while it doesn't dictate the value of your business, cash flow can certainly take away from the value of your business. And sometimes it's actually an indicator of business health. The health of your business can be described on your balance sheet and through your financial statements. And that's one important factor of the journey ahead. Does anyone actually know what their DSO is? Day sales outstanding. Does anyone want to call it out? What's go on. I know you want to do it, Ben. 37 days. Excellent. Sounds like me, I was a little while ago. But that could be also driven by the types of customers you have and the other terms. But do you... Average, yeah. Well, DSO is a measure of the days that it takes to be paid. So it's an average DSO. So Ben, how do you feel about being your client's bank? Not good at all. It doesn't feel great, does it? The interest that you earn from that money that you don't receive is zero. Yeah, okay. And the challenges that it brings is how many times do you have to call clients to get the check in the mail? Yeah. Did you want to have any comment to that? Yep. So you get a check, or do you?
So I worked really, really hard on this. Three years to get them ACH. Have probably about 15 holdouts.
Okay.
Because they do have T&M.
Yep.
Maybe something for the last year, not that supposed to be like hospitals and schools and whatever. They come around every couple of years for a renewal or something. But that's why I asked average, because that's not really fair. Because my 5 clients that pay at 392 days, tank all my good ones. So are we excluding that?
No, there's no exclusion. Okay, so you're using a weighted average towards good payers. I get that. Okay, no, that's fair enough. But then the question would be is, why are you providing services to someone that's out 390 days?
So they just went through a whole thing, you know, we talked about the backfires, the team that comes in and
Yeah.
they did that, it failed, so Australia's now taken over, we're getting 20 cents on the dollar, we're losing 167,000.
Oh, wow, that's a
We're
big,
getting like 26,000.
yeah, and that's a challenge. I was chatting to another,
We're writing them, and it's all personal because like they're like our friends.
well, they're not your friends. They owe you 167,000.
Workers are our friends.
Yeah,
The company itself.
yeah, yeah, well,
Like you could be the tech there and be my friend. We go out to dinner all the time,
yeah.
But you're
But he's not the one paying the bill. Yeah, absolutely. And I think that's a big challenge because you've got to make a decision at some point where you draw the line. Through the acquisition, post sale into PowerNet at the time, we actually saw one of our best customers drift. And they drifted so far that I was like, what actually happened? 4 days DSO. I knew exactly when something was going wrong. They went out 9 months at about $40,000 a month.
right.
That company went bankrupt on the 9th month. They had all the licenses, all of the services. We're talking T1 services going into buildings. There was cost associated with that revenue that wasn't generated and it was lost. So what I would say always is be on top of accounts receivable. Do not let customers go over 30 days if you can avoid it. And more importantly, hold them accountable to the outcomes that you expect. Don't be your client's bank. And Ben 37 is pretty good. That's, there's room for improvement, but it's not the worst that I've seen. And it's actually pretty good. So, that wasn't meant to be. Yeah. What I would love to be able to say to you is focus on driving that change in the sales cycle first. Start new. New contracts, new signings have the outcomes that you're looking for. The other side of it is who in here uses automatic payments? So thinking about auto pay, ACH, not where you submit it to your bank yourself, but actually driven automation. Okay. And then it stopped working. Okay. So thinking about automation should be about value to payment. Automation is not just about removing people from roles, it's about putting them to better use. So one of the things that we often see is when we start talking to new businesses about payment automation and improvement of cash flow and AR collections processes, we see the concern there, like, what about my job? Well, the reality is no one wants to collect anyway. No one wants to get on the phone and find out what's happening to that check. So that gives us time to focus on things that matter. So getting to a point where you've got the right systems and right tools executing growth. We over tripled in size in a matter of years, and we didn't need to add anyone in finance. Why? Because it was automated. A lot of that system was about efficiency and creating value.
And if I can add one more question on automation as well, one more statement, sorry, on automation as well. It's not just...
Didn't you build a business around that?
Yeah, a little bit. Yeah, it went all right.
Forgot.
Yeah. It's the functional automation of your staff, but it's also the functional automation of the engagement with your customers as well. I think that's super important. So it's how you send out invoices, how you create billing terms, flexible billing terms, customized billing terms for good or bad customers, depending on their nature. How you send reminders, how you send overdue notices, how you send termination or type, and then onto collections. That can be automated now through customer engagement. And not only is it automating the process, it's actually providing a more reliable service because they are reading their emails. I hope they're reading their emails. But it's prompted at the right times. It's not something that you have to look at.
Buy them a drink. Get the check. One thing I would love to say to you is, you've got a bad debt. There's $167,000 owing. Enter into a payment plan. Move that from AR into a liability. A long-term asset, and figure if you can recover it. No, they're gone now. Okay, well, write it off. Be done with it.
There was a bankruptcy 2 years ago.
Yeah, so you're waiting.
We took like a $10,000 hit, but we got it.
Yeah.
Then they did the private equity thing.
Yeah. And then wow. So one of the things I would say is be on the pulse of your DSO. focus on your financial literacy around your balance sheet and your income statement. Why do you keep pointing at me for you? So this is really good content, isn't it? She's like, keep looking up here. It's really good. So thank you to our amazing content writer, Eve, back in Australia, who puts together all of these amazing resources. And we've got a flyer here which we'll hand out before you go. So make sure you leave before, so don't leave before you get it. Because there's a great business case and information that you can access on our website there. So let's talk about EBITDA. And the EBITDA is, I think, one of the metrics that is naturally used to drive what is the value of your business. It's true profit before depreciation and amortization. So non-GAAP, essentially, but the reality of it is, when we look at how businesses are valued, there are many metrics that are defined, and we broke it down into about 6, and there is actually a case study, which I think it's at the end. No, I thought it was there. Not sure. It's definitely on the flyer. It's the mechanics in which you can build value in your business. And when we talk about this, as you can see on this slide, high risk is a business that carries an extended risk associated with a transaction. So that might be poor contracts, month to month, a lot of service-based type value in terms of the services that are part of that transaction. When we look at low risk, we're going to be looking on the other end of that scale, good contracts, good people. So if you think about the value and the mechanics in which you think about valuation, here are the multiples where we were looking at, well, what are people paying based on the various different EBITDA levels for revenue. So 0 to 5%, you're really not going to get very much for your business. If your EBITDA is under 5% of gross revenues, you're not going to have a good outcome in a transaction. So I would say keep focusing on improvement, use the modes theory, join a peer group, join Evolve. That was one of the things that I did. I joined Evolve, and it helped me immensely to build my business and to create value as part of that transaction. As we go up and we've got higher levels of EBITDA, then we can create more value for an acquiring party. We can demand greater multiples of revenue, or multiples of EBITDA, which ultimately creates better outcomes and value for you. Here's an example of something that I've tried to make really simple, because this kind of looks a lot of information. You can get up to 5.5 times your EBITDA value in a low-risk transaction at 20% EBITDA. That's the matrix that works behind it. But if I had $1.5 million in revenue and I had an average of 11% EBITDA at $165,000, a high-risk business would probably get about 0.75% of EBITDA. That means that my business is worth $120,000. You could probably, it's barely even a paycheck for most senior managers in terms of the value that you're creating. This is legacy value. This isn't about your next paycheck. This is a business you built and ultimately created value from. If we take that same business and deal with the things that are important, contracts, people, processes, and systems, creating outcomes for the products and services that we sell that are clearly aligned to what creates value, by moving through and up into a lower risk business transaction, you can see just how that same revenue results in better outcomes. At 3.5%, we're talking over a $500,000 check. That was when we started, this is my era when I sold. If we have a look at how that looks today, it's a vastly different world. Why do you think Evergreen was standing on stage saying how awesome MSPs are, and we've got a truckload of cash and we want to buy a bunch of businesses? 70 businesses have been part of that Evergreen portfolio growth. And there's a number of others out there. New Charter. There is, the names have just completely escaped my mind. New Charter, Evergreen, already forgot it. So anyway, there's a bunch of them out there, and they're all out there looking for amazing, what they call targets, because targets are the businesses that are standing here or sitting here in front of us. Your businesses should be for sale. Whether or not you get the value that you want as a business owner is the question that you can ask yourself. Is this legacy, or is it just transactional? Am I going to go and do it again, or is this the retirement that I've built this business for over the last 20 years? And I've seen some amazing transactions in the last 12 to 18 months In fact, the company I sold to, PowerNet, was recently acquired by a company called VITG, which is an investment-backed conglomerate as well. If we look at those values, the same EBITDA, adjusted EBITDA values in the US currently is 4.45%. It's pretty amazing. If we go up to over $15 million in EBITDA profit, 15 times. That's a lot. That's a lot for a business of $100 million. We're talking a check size of $100 million or more. If we look in Australia, unfortunately, we're not quite as the same levels of the US. Looking at the lower end, 1 to 3, mid-range between 3 and 8, that's where we see most transactions take place, businesses around that mark, 3 to 5.5 times. New Zealand, that's the top end. And the UK, you can see they're under £500,000. They're getting a premium at 1.5 to 2 times as well. So these are the reference points for current market conditions as referenced by people that are in the market seeing these transactions. This isn't hyperbole, it's actual information that you can take and understand where you could sit. I think there was a QR code that Evergreen put up on the screen just to get a base understanding of what your business might be worth. Recommend start the conversation, even if you don't do anything, at least you know where you sit. I did that twice before I sold my business because I knew that what I was going to get wasn't what I wanted, and I created better value and more transactional outcomes for me as the leader or the owner of the company towards what ultimately was the exit that I was looking for. If anyone has met Focus Banking Group or Focused Investments, Abe Garver sits on the Corporate Advisory Council for ConnectWise, heads up an amazing portfolio company which ultimately is out looking for mid to large scale transactions. He shared this from one of his slides, which was part of their business is ultimately working with businesses to create value. Add-on targets, what they define are businesses that ultimately add some value. So that is when we acquire a business, we tuck it in and it creates value for a broader part of our portfolio. If I was an add-on target, my EBITDA multiple is going to sit between 5 and 9 times EBITDA. Fairly basic, normal, single MSP. If I was to take a couple of those MSPs and join them together and create a small cohort of businesses for acquisition, I would simply take my EBITDA value from 5 to 9 to a 9 to 11.5 with the same companies. Now, obviously, you can't just mash 3 companies together. There needs to be some synergy, but they're not integrated. So there might be common platform. They may not be common platform, but they're synergistically aligned towards outcomes such as what they call pure play MSPs. If I take a bunch of those cohorts, so companies that have acquired 3 or 4 companies together and move them into larger PE-backed direct investments, then we're talking 12 to 20 times value. That is where the money is moving. So what I'm showing you this for is not to think that everyone in here is going to automatically get 20 times EBITDA returns on their MSP doing $1 million a year. But the reality is there's strategic alliances that can be formed, built, and more importantly, executed that can drive outcomes that are out of this world. Now, how long will this happen? How long will this be here for? How long will the cash remain? No one knows, because it could be gone tomorrow. It could be here for the next 5 years. Evergreen, New Charter, and others are showing us that there's great opportunity here. If you're not ready to sell, get ready to sell. Find the value in your company, and more importantly, create the opportunity for you to bring legacy wealth to your family, to your people, and more importantly, to your staff and others as well. So thank you to everyone. John, I'm not sure if you wanted to close out in your experiences as well.
Yeah, the way I'd just like to wrap it up is we took you through 6 pillars today. 6 is a lot to take in. So that's why I said at the start, your business is always for sale. I think that's the message we want you to walk away with. Then you can start working backwards. Look at these 6 pillars that we've talked about. How can you move up the ladder or down the path to increase that, reduce the risk to increase your valuation? Each one of these steps is super important to increase your valuation. So we'd like to hope that each one of them does resonate with you and your businesses as well.
And before we wrap up, now's the time for questions and answers. So would anyone like to ask any questions or contribute to the discussion? Here to form part of ultimately what is a great session, hopefully.
And happy to stick around in the hallway afterwards for questions as well.
Here's a little flyer, as promised. $10 to 12% a typical profit margin for an MSP. I would say that it's probably on the average side, but then I would expect to see high teens to low 20s for good growth margin. But 10 to 12 is profit, like you're making money. So, obviously size of business is key, but more importantly, what you do with that profit is also important too. So if you can create value in your business by using that profit efficiently, then you can also say that it is good purpose.
Any other questions? Yep. Yeah. Look, I'll probably let Paul talk about it.
Yeah, I was going to say, repeat the question just for the people listening in at home. So how do terms drive discussions around price, whether you might offer a discount for an earlier payment? So I've traditionally avoided moving down the path of having a discount for early or on-time payment. I just think it's like the services we commit to are the services that you should be paying for. You can't walk out of a hamburger store with a hamburger and not have paid for it. We're not talking about commodities here, but we are talking about services delivered and rendered. So ultimately, those services should be paid. We need to move from terms-driven discussions into the value of service to be provided. And if you're thinking about prepaid services, start of the month for the month in advance, that's a great way of moving from net 30 into here are the services in which you'll consume, and that is what you're paying for. So to answer the question, you would not do 5%. Way too much. Yeah. Yeah. No, I understand the context there. The 5%, the concept there of a discount on early payment or moving towards something could be a mechanical way to approach it, but put some guardrails around it. So a great way of an example there would be if you're looking for a way to incentivize the adoption of autopay, you might do so and say, look, our normal price increase is 6% to follow inflation and cost of living, etc. We're going to hold that at 3%, providing you move to a auto pay. So you haven't lost revenue, you've generated an increase because of inflation, but you've also incentivized the move towards a mechanism in which you get paid sooner. And I would always suggest, where possible, to pass on the cost of the credit card surcharge, or what we call in America the cash discount removal fee, because that is ultimately 3.5% of revenue could be as much as 60% of gross margin on an Office 365 license. So immediately you've already dropped, if we're thinking about your question the gentleman asked before about is 11% a good EBITDA margin, imagine if your EBITDA margin was eroded by credit card surcharges. I had one gentleman come up to our booth just before and say, I'm paying $250,000 a year in credit card fees. How could I offload that? Well, by simply saying, you want the points customer, you pay the fee. You want to fly your family to Tahiti for the holidays, that's okay, but you're going to have to pay the fee. There's a fee-free alternative, ACH, debited from your account. That's the way to do it. The other thing, which is actually a great, Curtis, who walked in and left promptly, because he had to get back to the booth. In the US, you guys love checks. Pretty much one of the last places on earth that use checks, but that's okay. You can hold on to that. Yeah, well, America likes checks. So the accounting team doesn't, but the cultural thing is. So let's talk about checks. What's written on the bottom of a check? And the routing and account number. So if you wanted check fraud and routing fraud, what would you do? You'd steal someone's check. You'd get their mail, et cetera, et cetera, et cetera. Check fraud in the US is going through the roof. Why? Because people are still mailing checks, and someone finally figured out that all the information they need is written on that thing that goes through the mail. So that's a great initiative for you, thinking about security of your customers' banking details. Customers, we're actually looking at how we can help protect you and your services and your banking accounts by making sure that you do not send us checks and expose yourself to check fraud. It's on the rise in the US, and we're looking for ways to protect you by offering this secure online payment. We don't even see your routing and account numbers. It's all securely stored in a payment provider's vault, same way that credit card numbers need to be secured. That is the way in which you move people from a piece of paper that's a promise for the future into something that's ultimately an opportunity to help them protect their banking identity.
And tie it back to cash flow, of course.
Of course.
How long does it take a check take to bank?
Oh, yes.
Yeah. What happens when it doesn't have funds? How often do you hear the checks in the mail when you're chasing up customers? You've got full visibility over it once automatic payments have been set up. You see the schedule. You know that it's coming. You've got that certainty of payment, so therefore your cash flow's improved.
And sorry, John, and I know we do have one question here, so just before we get to that, one of the great things, again, you know, we built the product WisePay for our business as an MSP to deliver value to us. One of the conditions that I had when we were looking for payment providers was real-time, or at least next-day settlement. We wanted gross settlement with fee debit separate. We didn't want this concept of we get less money than what we collected and then the invoices never match the amounts paid. Really painful experience. But the outcomes of that are quite simple, that we look to partner with a payment company that would create simplicity for us so we didn't have to worry about it. And that's where Global Payments for us has helped that journey by saying, give us all the money, fund it next day, and then if it gets, you know, if there's insufficient funds, that'll be what's called a late rejection. So that's a great feature and service that forms part of what WisePay does.
So you talked about the payment side, which is our customers now have, and we deal with this because we're also customers of a lot of vendors that we pay invoices.
Mm-hmm.
So everybody now has their own WisePay solution, which isn't WisePay. It's
If only it was.
all these different
Yeah.
things. When are you guys going to turn your attention to the payment side,
The actual payable side.
cash outflow? Because our customers actually aren't happy with the fact that we presented them with a one-off way of paying us. They like checks because they can run 100 checks and put them in the mail. It's one process.
Yeah, brilliant question. And sorry, I didn't catch your name. I can't see. Keith, thanks, Keith. So Keith's question was, you know, how do we transition the mindset of our customers towards, you know, multiple concepts of payment platforms? Like, there's so many payment platforms out there, right? That's the root of what you're saying, is that how do you get them to see that there is a better outcome? Or is this a case of just...
For example, we haven't gone through any AP automation because I don't know which one to pick. Secondly, at some point, my bank will allow me to do ACH transactions, and I've got my own automated payment, but it's uniform, so I can go through a whole list of vendors, plug numbers in, and send payments out, and I just have to collect the ACH information from my vendors so that I can make those payments.
Yep.
But there's still no good automation. Like ConnectWise isn't seemingly interested in solving that problem, and so I've got QuickBooks doesn't seem to
Don't want that either.
interested in solving that problem. When are we going to see that step up? And then secondly, how do I tell my customers, they're all on different accounting systems, and they're pissed off with because we sent them something that says you got to use our payment portal, and they're going, yeah, sure.
Another one.
We're a huge law firm. We've got 3,000 employees. We've got tons more vendors than you to worry about, so get in line.
Yeah, and look, that's really great, you know, in terms of the mechanics that you would see inside of the question that you're asking is, how do you actually deliver value that's consistent to that client so that the services you provide don't create more work for them? Because they still need to pay the bill, right? They've still got to go through their accounts payable process. They still need to send you a check. So there's a number of steps that they still need to do inside of their accounting system to even get to the point where the check gets run, even if it's a stack this tall of outbound payments.
Is there something in between auto pay, like the moment they receive it, it gets paid, versus you've got it, you can
Yeah, of course.
Yeah.
Fully configurable. You could say, and this is a great example because you're transitioning from 30 days EOM or 30-day term to next day in terms of 0 days, so first of the month. That could be transitional. So you can have different terms that predicate how that transaction would run. So a great example is it's dated the first of the month, it's not due till the 15th. The draw happens on the 15th of the month, not on the 1st. You control that. That's the mechanical process that you have the access to inside of the system. All you need to do is just define on your agreement if it's auto pay on 15 days or on one.
Then they have that time to deal
To check it, and actually, sorry, I know you're trying to provide some context, so I'll come to you in a sec, Tracy. The point being here is that when we think about the process of that, I had everyone on auto pay, and then the stragglers, I said, well, what about if I give you 2 weeks to check over it because you don't trust the system or you want to look at my invoices? After about the 3rd month, they're like, look, can you just put everything else on auto pay because, yeah, we're happy. So we saw a transition of some on auto pay and others not, and we just controlled that in the agreement. So we didn't allow them to choose to not pay our managed services and our license-based agreements and internet costs and the things that are like, you've got to pay that. That's not a choice. You signed a 3-year contract that said this is the amount set in stone. You've got commitment in that. We've got commitment in that. Let's do that on auto pay. The services that we bill you ad hoc and bespoke, we'll let you have 2 weeks to look at it. And if you're happy, reply, we'll just hit the bank account saved on file. That was the way we did it. And that was, you've got flexibility to do that. The other side of it is, what about all these different systems? If you're using CPQ, when they pay and approve a quote, they're automatically in the flow. They don't have to think about using another portal, logging in with credentials. They can simply just type the information in right there when they're accepting the quote. So you've got the ability to have it as part of the acceptance of that. You need to put your payment method in order to accept this quote. That's the way it works. So you can actually embed it in process rather than creating an adjunct process that requires them to know which portal to go to. One of the things that we did build our platform for is all roads lead to Rome. All roads lead to Rome because wherever you click a button or come into the process, it comes into the WisePay portal. So they always have that familiar entry point no matter where they go. Tracy was first and then I'll come to you.
You know, to kind of answer your question also though about the middle ground. So our clients, probably 10% of them, we use like 10% of them are on auto pay probably. But the majority of them, what they do is they still do the ACH payment, but because when we send the invoice, they have a link to click through the invoice straight in there through WisePay portal. We save all of their ACH or credit card information in the system. So basically when they go in, correct me if I'm explaining this wrong, they can click through the link of the invoice and all of their information is saved. You can't access it on our side, it's all mass. But then they can just pay it right there. So that's sort of in between because they still have the control to pay it. All of the information is saved. They just have to click a button basically to pay it. So even though it's not auto pay, they do still have to go with another system, but they're in their invoice processing it already anyways. So they can schedule the payment ahead of time. So say they don't want to pay it today, but they want to schedule it because we bill our clients 1 month ahead. So they get the invoice on the first of the month, the next month's services is due by the first of the next month. They can process their invoice on the 15th, set it up to schedule to pay 15 days from now on the first of the month.
Do any of you have clients where the person who approves, who's buying, is not accounts payable, and who have to then, they get that, they have to be the one to approve it?
Yeah.
Send it on to accounts payable to do?
Two to approve or multi-signing.
Because in that scenario, we would typically have an IT person getting that piece. Well, they don't have the credentials for the bank account. They can't make a payment. They can do none of that.
Most of our invoices go straight to the accounts payable processor, and then they handle on their side the approvals and stuff. So for the most part,
So you send invoices to non-accounts
We deal with
people?
law firms, so we deal with a lot of people who are either attorneys or IT people within law firms.
Got it.
And they are very particular about what they're buying. They want to see it all before it doesn't go the other way around.
Yeah, that's fine.
Very bad account. Administration is not a big high thing at
Yep.
law firms, so to send it to.
They bill by the minute, so they've.
Some of them do. I can't say they all do.
Yeah.
But a large part of them, it's.
as a client also, they were slower to get the monthly process, but they were all about sending a check also.
And I've worked with large local governments and traditional businesses that will not do direct debit, and there is a way to get that to be completed if the decision is, this is how we receive payment. You're signing a contract that is auto debit. This is the way we do business. Like, I don't want to have to call you and ask you to pay so that I can pay payroll. So that's a fair and reasonable business arrangement that you and I have, is to make sure that you're going to pay me on time. So we're going to set this up, but this is how we can manage the expectations on the back end of that. The contract is the legal obligation to pay. The accounts payable process ultimately comes back to what their processes are, which can be flexed to whatever needs to be done, providing it's your firm with ultimately what the outcomes are. And we are out of time, so I appreciate everyone's time in here, and thank you for your questions. We'll stick around for a few minutes after, and enjoy the rest of IT Nation.
Thanks so much.